A guy I know made $320,000 last year. That's more than his father ever earned in a single year, even adjusting for inflation. He drives a Tesla Model Y, lives in a neighborhood with good schools, takes his family to Hawaii every summer, and he can't afford to quit his job for 6 months. Not because he's reckless, because he's responsible. He's got a mortgage that runs $2,800 a month, 2 car payments totaling $1,100, childcare at $1,800, and a lifestyle that quietly demands every dollar he makes. He's built himself a really expensive cage, and the lock is made of payments that never end. Here's what nobody tells you about your late 30s and early 40s. The traps that destroy your financial future don't look like traps. They look like achievements, and the men who fall into them aren't stupid or careless. They're doing exactly what society programmed them to do. I'm gonna walk you through the 4 biggest financial traps that catch high-earning men between 35 and 45. The psychological machinery that makes them invisible, and the specific reason this decade is more dangerous than any other. Because the math on this is brutal. The difference between getting this right and getting it wrong isn't $10,000 or $20,000. It's 7 figures over your lifetime. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Think of your lifestyle like a ratchet wrench. You know the tool, clicks in one direction, turns freely. But here's the thing about a ratchet. It doesn't go backward. Every time you upgrade something in your life, you're clicking that mechanism forward. And once it's clicked, reversing it feels like failure. That's the central mechanism behind every trap I'm about to show you. You ratchet up, you can't ratchet down, and eventually you're turning a bolt so tight you can't breathe. Trap 1. You mistake revenue for runway. There's this moment that happens to most men around 37, 38 years old. You cross 6 figures. Maybe you hit 120, 150,000 in total comp. For the first time in your adult life, money stops being the bottleneck for normal decisions. You don't check your account before dinner. You don't think twice about the $90 grocery bill. And something in your brain whispers, I've made it. That whisper is expensive. Because what actually happened is your income went up. Your wealth did not. Let me tell you about a hedge fund analyst I met in 2023. Guy was pulling down $240,000 a year, lived in Austin. I asked him how much he had invested outside his 401k. He said about $35,000. I asked where the rest went. He looked confused. Then, annoyed, like I'd asked him why he wasn't living in a studio apartment eating ramen. Here's what happened. He bought a house right when rates were low. Good move, right? Except he bought at the top of his budget because the bank approved him. That pushed his payment to $4,000 a month with property tax and insurance. Then he needed furniture, not IKEA furniture, good furniture. Because you don't put cheap furniture in a $500,000 house. Then his wife wanted to redo the kitchen because the cabinets were dated, $15,000. Then they had a second kid and needed a bigger car. He leased a Yukon Denali at $870 a month. Here's the thing, none of that is crazy. That's just what people do. But his burn rate went from maybe $5,500 a month when he was making $110,000 to $9,200 a month when he was making $240,000. His income more than doubled. His savings rate got worse. You know what happens when your burn rate is $9,000 a month? You need to make $135,000 a year after tax just to break even, which means he needs to gross probably $180,000 minimum. And now he's trapped. Can't take a sabbatical, can't take a risk on a startup, can't move to a lower cost city for a better quality of life. His income gave him lifestyle. It didn't give him options. According to a 2024 study by the American Psychological Association, individuals earning over $200,000 a year report nearly identical financial stress levels to those earning $75,000. That's not because money doesn't matter. It's because the ratchet clicked. Their lifestyle expanded to meet their income, and now they're running the same race, just on a more expensive track. The psychological shift here is critical. When you're in your 20s, you know you're broke. You're aware. You make decisions accordingly. But when you hit your late 30s and your income spikes, your brain starts categorizing purchases differently. You stop thinking in terms of trade-offs. You start thinking in terms of affordability. And affordable just means the monthly payment doesn't bounce. I can afford an $800 car payment. Sure, your checking account can clear it, but can your future afford it? That's a different question. Because that $800 a month over 6 years is $57,600. And if you'd invested that same amount in an S&P 500 index fund at historical 7% returns, it'd be worth about $73,000 by the time the loan was paid off. You didn't buy a car. You sold your future $73,000 for the right to drive something shiny today. Here's where it gets really interesting. Trap 2. You finance comfort instead of buying time. Let me tell you a story about two brothers. Both software engineers, both made $160,000 a year in 2019. Brother A bought a house in the suburbs, 30-year mortgage, $350,000 purchase price. Put down 20%. Payment was around $1,900 a month. Bought 2 newish cars on 5-year loans. Combined payment, $900. Total fixed obligations before food or utilities, about $3,200 a month. Brother B rented a smaller place for $1,400 a month. Bought a used Toyota Camry in cash for $14,000. Fixed obligations, $1,400. Fast forward to 2024. Brother A still has 26 years left on his mortgage, still making the same payment. His home appreciated, sure, but it's illiquid. He can't access that equity without selling or taking on more debt. His car's depreciated. He owes $8,000 on one, just paid off the other. He's got about $90,000 in retirement accounts and maybe $20,000 in savings. Brother B has been investing the difference aggressively. That's about $1,800 a month. Over 5 years with average market returns, he's got around $147,000 in a brokerage account, plus another $110,000 in retirement accounts. Total liquid net worth, about $257,000. Brother A's net worth on paper might look higher if you count home equity. But here's the question. Who has more freedom? Brother B can quit his job tomorrow and live for 3 years without touching his retirement money. He can take a pay cut for a better role. He can move cities without selling. He bought time. Brother A bought comfort. And comfort has a payment plan. The shift happens around 36, 37. You've been grinding for 15 years. You're tired, your back hurts, you've got kids, you want life to be easier. So you start making decisions that optimize for present comfort at the expense of future flexibility. You finance the nicer car because the payment is only $300 more a month and it has heated seats and adaptive cruise control. You buy the bigger house because you're tired of feeling cramped. You pay for convenience, meal kits, lawn service, house cleaning, and every single one of those decisions is rational in isolation. But here's the brutal part. They're cumulative. Each one raises your break-even point, the amount you need every month just to keep the machine running. And once that number gets high enough, you're no longer making decisions. Your overhead is making them for you. You can't leave a toxic job because you need the paycheck. You can't negotiate hard because you can't afford to get fired. You can't say no to the promotion that requires 60-hour weeks because the raise pays for the lifestyle you've already locked in. You traded your leverage for leather seats. Now you might be thinking, okay, but I've got kids. I've got responsibilities. I can't just live like a monk. Fair. But here's the thing. Buying flexibility doesn't mean deprivation. It means being intentional about which expenses are expanding your options and which are closing them. Paying off your mortgage early expands options. Financing a kitchen remodel closes them. Keeping a paid-off car expands options. Leasing a luxury SUV closes them. Every financial decision is either buying you freedom or selling it. And most men in this age bracket are selling without realizing it. Trap 3. You let obligations compound faster than assets. Here's a scenario. You're 41. Your mom is 68. She's got some health issues. Not serious yet, but you can see where it's going. She lives 4 states away. in a small apartment. You start thinking maybe it makes sense for her to move closer, maybe even move in eventually. So when you're house hunting, you look for something with a mother-in-law suite or an extra bedroom. That's responsible, right? You're planning ahead. Except now you just added $150,000 to your purchase price for space you might need in 5 years. That's an extra $600 a month in mortgage payment. Plus, the bigger house has higher property taxes, higher insurance, higher utilities, higher maintenance. You just raised your break-even point by about $900 a month permanently for something you might need. Here's another one. Your brother-in-law asks you to co-sign a loan. He's starting a business. Banks won't touch him. He just needs $25,000. He'll pay you back in 2 years. You say yes because you're family. And now you're on the hook for $25,000 plus interest if anything goes wrong. You didn't borrow the money, but your credit is tied to it. Your risk is real. Or this. You've got 2 kids. Public schools in your area are fine. Not great, but fine. But private school is better. Smaller classes, better resources. It's only $18,000 a year per kid. You can afford it, technically. So you enroll them. And now you've committed to $36,000 a year in after-tax spending. That's about $50,000 in gross income just to cover tuition. Every year, for the next 10 years, you just locked in $500,000 in future obligations. Again, maybe that's the right call for your family. But here's what I want you to see. Each of these decisions is adding weight to the machine you have to keep running. You're not just raising your expenses, you're raising the floor, the minimum amount you need to survive. And every time that floor goes up, your freedom goes down. There's a concept in finance called burn rate. It's how much cash a startup goes through every month. Investors watch it obsessively because it tells you how long the company can survive. Most men never calculate their personal burn rate. They should, because once you know that number, you know exactly how trapped you are. If your burn rate is $5,000 a month and you've got $100,000 in savings, you can survive 20 months without income. If your burn rate is $12,000 a month and you've got the same savings, you're done in 8 months. That's the difference between having options and having panic attacks. This is where it gets really interesting. Trap 4. You assume this is just what being an adult costs. Here's the most dangerous psychological trap of all. The normalization of high overhead. You look around at other guys your age and everyone's in the same situation. Everyone's got the mortgage. Everyone's got the car payments. Everyone's got the private school tuition and the travel hockey fees and the subscription stack that runs $200 a month. So you assume this is just what life costs now. It's not reckless. It's normal. And that's the trap. Because when your financial stress looks like everyone else's financial stress, you don't question it. You just accept it as the price of entry to middle-class adulthood. But here's the thing. Normal is not the same as optimal. Normal is not the same as sustainable. Normal just means most people are making the same mistakes. Let me give you some numbers that should make you uncomfortable. The median household savings rate in the United States is around 5%. That means half of households are saving less than that. For a household making $120,000 a year, 5% is $6,000 a year. Over 30 years at 7% returns, that's about $570,000. Sounds decent, right? Except inflation will cut that purchasing power in half, and you'll need way more than that to retire with any dignity. Meanwhile, if that same household saved 20%, which is 12 times more per year, they'd have over 2.2 million in the same time frame. The difference between 5% and 20% isn't incremental. It's generational. But saving 20% when you're financing a lifestyle that demands 95% of your income is impossible. You can't save your way out of structural overspending. You have to cut the structure. Now you're asking yourself, how did I get here? Here's how. Around 35, 36, a bunch of things happen at once. Your income jumps. You feel like you've earned the right to upgrade. Your peers are upgrading. Social media shows you a highlight reel of people living better than you. You've got kids, so you're optimizing for their comfort and opportunity. And you're tired. You've been hustling for 15 years, You want life to feel easier. So you start saying yes to things you used to say no to. And every yes is a ratchet click. The bigger house, click. The nicer car, click. The private school, click. The boat, click. And here's the cruelest part. Each upgrade feels good for about 6 weeks. Then it becomes your new baseline. The luxury car just becomes your car. The bigger house just becomes your house. The novelty wears off, but the payment doesn't. So now you're running faster just to feel the same. Hedonic adaptation is the term. Your happiness returns to baseline no matter how much you upgrade your circumstances. But your burn rate doesn't return to baseline. It just keeps climbing. Let me tell you about a guy who figured this out the hard way. VP at a tech company, made $290,000 a year in 2021, got a $50,000 retention bonus. You know what he did? Bought a boat. $42,000, financed it over 7 years at 6% interest, payment was $570 a month. He used the boat 11 times the first year, 4 times the second year, once the third year. Then he sold it for $26,000. By the time he paid off the loan early with the sale proceeds, he'd lost about $23,000. But here's the real cost. If he'd invested that $50,000 bonus instead, it'd be worth around $78,000 today. He didn't just lose $23,000 on the boat. He lost $55,000 in opportunity cost. That's a year of his kids' college tuition. That's 6 months of living expenses if he lost his job. That's freedom he sold for 11 days on the water. Here's the mini case study I want you to sit with. 2 men, both 40 years old, both make $180,000 a year. Man A has a burn rate of $13,000 a month. Mortgage, cars, subscriptions, lifestyle. After taxes and expenses, he saves about $800 a month. Man B has a burn rate of $7,000 a month. Same income. After taxes and expenses, he saves about $4,200 a month. Over the next 20 years, assuming 7% returns and no income growth, Man A will accumulate around $470,000. Man B will accumulate about $2.4 million, same income. 5 times the wealth. The only difference is the ratchet. Man A clicked it up every time he got a raise. Man B kept it where it was and banked the difference. Now, to be fair, Man A might have a nicer house. But Man B has something better. He has the option to stop working at 60 if he wants to. He has the option to take a year off at 55. He has the option to tell his boss no. Man A will work until 67 and hope his health holds. That's not a moral judgment. That's math. You might be thinking, okay, but what do I actually do about this? Here's the thing. You can't undo the past. You can't unfurnish the house or give the kids back the private school experience. But you can stop clicking the ratchet forward. You can audit your obligations, pull up your bank statements, add up everything you're contractually obligated to pay every month. Mortgage, car payments, insurance, subscriptions, tuition, anything that doesn't stop if you stop choosing it. That's your floor. If that number is above 60% of your take-home pay, you're in the danger zone. You're one layoff away from serious trouble. If it's above 70%, you're not building wealth, you're building risk. The fix is uncomfortable. You might need to sell the car you love and buy something boring. You might need to downsize the house. You might need to pull the kids out of private school. And every one of those decisions will feel like moving backward. That's the ratchet talking. It's not moving backward. It's buying back your future. Second thing, separate your identity from your stuff. This is the psychological work. A lot of men tie their self-worth to external signals, the neighborhood they live in, the car in the driveway, the watch on their wrist. And when that happens, cutting back feels like admitting failure, like announcing to the world you couldn't hack it. But here's the reality. The guy driving a 15-year-old Camry with $2 million in index funds is richer than the guy driving a Range Rover with $100,000 in debt. One of them just looks richer. And if you need to look rich to feel valid, you'll never be free. The real flex is not needing to flex. Third thing, treat every future financial decision as a freedom calculation. Before you buy, before you finance, before you commit, ask yourself one question. Does this give me more options or fewer? Does this expand my future or narrow it? A paid-off car gives you options. A lease takes them away. A low burn rate gives you options. A high one takes them away. Investing gives you options. Spending takes them away. Every dollar is a vote for the kind of future you're building, and most men are voting for a future where they're still grinding at 65. Here's the part nobody wants to hear. The best time to fix this was 10 years ago. The second best time is today. Not next month, not after the next bonus, today. Because every month you wait, the hole gets deeper. Your lifestyle gets more entrenched. Your obligations get harder to unwind. I've been running my own business for over a decade. I've got multiple hundreds of thousands of dollars invested. I'm not coming at this from theory. I've sat in rooms with accountants and fiscal lawyers who showed me how the math actually works. And the math is simple. Wealth is income minus ego. The moment your ego requires you to look successful, you lose. Because looking successful is expensive. Being successful is quiet. Lazy investing built more fortune than crypto memes. You know why? Because lazy investing is just buying index funds and not touching them for 30 years. It's boring. It doesn't make you feel smart. It doesn't give you a story to tell at parties. But it works. And the men who get rich in their 50s and 60s aren't the ones who swung for the fences. They're the ones who save 30% of their income, live below their means, and let compound interest do the work. The men who are still broke at 50 are the ones who looked rich at 40. So here's what you do. 1, calculate your burn rate this week. Every fixed obligation. Add it up. If it's over 60% of take home, you've got structural problems. 2, identify one obligation you can eliminate in the next 90 days. Sell the car. Cancel the subscription. Downsize something. Just prove to yourself you can click the ratchet backward. 3, automate your savings before you see the money. If you're not saving 20% of gross income, you're not building wealth, you're building a lifestyle. Set up automatic transfers the day you get paid. Pay yourself first. Everyone else gets what's left. And if you're sitting there thinking, this sounds extreme, ask yourself this. What's more extreme? Living below your means for 10 years so you can have options for the next 30? Or living at your means for the next 30 years and having no options ever? Most men choose the cage because it's comfortable, and then they spend their 60s wondering why they can't stop working. You've got time, but not much. The window between 35 and 45 is the most important financial decade of your life. You're earning more than you ever have. You've still got 20 plus years to let money compound. But if you spend this decade clicking the ratchet up, you'll spend the next 2 decades trapped. Your call.